So welcome to this week's episode of the Fit Finance Sessions with me, Henry Elliston, and I'm joined today by just Tim Webb. Tom has decided that just before the end of the tax year is an ideal time to go away on holiday. So I hope he's having a great time at home painting his bedroom. Tim, hi, how's it going?
Yeah, very well, thanks mate. How are you?
No holidays for you, no doubt saving them all for the summer when lockdown's over and we're allowed out and away on holiday again.
Absolutely, yeah. I'm seeing how long I can last without a day off work, I think.
Yeah, me too. So I thought today we'd just talk a little bit about the markets. They've been a bit up and down of late. Certainly, looking at my portfolio and some of those of our clients, they seem to get off to a rip-roaring start to the year and then pared back a little bit over the end of last month. What's been happening?
Yeah, well, I think I don't know about you, but I've been having quite a lot of clients that question me on my views on that side of things. You know, as you say, it started off well into 2021, a little bit of a pullback, and now things seem to be continuing to the upside, which is clearly good news for markets and the economy and therefore portfolios. So yeah, I just thought today let's have a bit of a chat about it. I mean, a couple of more major things in the last couple of weeks. Obviously, the 1.9 extra trillion monopoly money, really, isn't it? Donated, if you like, or printed over in the US, which again, good news, great news. Market is doing quite well off the back of that. But I think more majorly, there was the inflation recording over in the US for February, came out of 0.1, whereas it's forecasted or expected to be 0.2. So that although it doesn't sound like a major difference, of course, that one of the major concerns over this entire COVID period of all the money that's being printed, etc., is the expectation for serious inflation off the back of it, which typically then has a negative response in the market because interest rates then are raised and the differential between the value that you're getting in the stock market versus having cash basically is smaller. So given that the inflation on a month basis wasn't actually so bad, gave it a quite nice bounce actually, nice bounce in the markets last week and continuing this week. I saw world stocks this morning are still inching up higher. The futures market has opened higher. Just before the market opened this morning. So it's good news. It's all good news on the front of it. I mean, I think we're still not, you know, I heard an analogy a couple of months ago where, you know, when all this stimulus and support disappears, we'll then get to see the true state of play. And, you know, when the tide goes out, we'll get to see who's wearing trunks type thing. And I think there is some truth in that. I think we are still potentially superficially being held up. You know, people out there are still, businesses and individuals and families are still just being supported with these government checks and what have you. But at least for the, you know, for the foreseeable, it seems to be good news. Andrew Bailey, the chief of the Bank of England, said actually the UK is expected to get back to pre-COVID levels by the end of this year. I think it was Q3, Q4. Whereas the US actually is just surpassed, if I'm not wrong, pre-COVID levels. So we're sort of, you know, head now officially back up above water level, really. But, you know, just another caveat, I suppose. You know, clearly no one knows what's going to go up, down, sideways, what have you. But at the moment, it does seem to be quite a good place. So for those people sort of sitting on the side and still holding on and waiting to see what's going on, I think you're going to be left behind to some degree on that front. So it's still, you know, it still is worth taking a serious look at your investments.
Yeah, I think it's interesting actually. I mean, I agree with everything that you say. I suspect over the course of the year we will continue to see some volatility. I mean, there's always volatility in the market, right? So we're never going to get rid of that anyway. But there's going to be some sort of COVID-linked volatility just because all of a sudden you'll see a big flash of inflation coming through, and then everyone will get panicked and they'll think interest rates are going to rocket up, and that'll see a sell-off in the stock market. And then, you know, you can just see it that a week or two down the line, one of the airlines comes out with staggering profit figures, or one of the hotel companies shows that bookings are up for the rest of the year, and that'll then suddenly drive the market up again. And you can just see these sort of swings in volatility that'll just come throughout the course of the year. The other thing that I thought is quite interesting, and it's something that we've been looking at in our portfolios, our portfolio metrics portfolios, and they've been warning, I suppose, fairly over the last 6 months. There's this swing away from growth stock investing and into value stock investing, and as I see it, that play actually sort of works really, really well in this time where there is a feeling that inflation might go up and interest rates go up. So one of the big value sectors would be the finance sector, so the banks and the insurers. And of course, when interest rates go up, banks can start making money again. I mean, one might of course say that banks are always making money, but it's certainly a lot easier for a bank to make money if they can charge an interest rate that's a little bit higher than zero. So it'd be interesting to see actually if that really does start to swing away from the growth stocks. And I guess the growth stocks, a lot of them are the tech stocks. And if the tech stocks have had their time in the sun because we've all been sat at home using tech, but come the summer, we're all going to go outside and start partying and drinking and staying in hotels and eating out in restaurants. That really is a time for the tech stocks to fall off a little bit. We're not going to be on Zoom quite so much, please. So it will be interesting. I mean, in truth, I think Zoom's here to stay. I mean, I think it's transformed the way business is done, and I'm sure Zoom will be a useful part of any portfolio for the years ahead. But perhaps it won't be in quite so much limelight later this year as it has been in the last year.
No. Well, it goes back to what we were saying last week, doesn't it, about the working from home sort of shift that we can see moving forward. And I think, as we said last week, it was Lloyds, wasn't it, saying that 40% of 25,000 of their employees, 40% of their time, they get a grant to be working from home. So yeah, I'll definitely agree that Zoom is not going away, but for the better or for worse. But yeah,
yeah, quite well. Fingers crossed. A week and a half until we can all go outside and play golf and tennis again. So the light is definitely there at the end of this seemingly infinitely long tunnel.
Yeah.
Can't wait. The sun's shining outside. Anyway, look, thanks very much for joining us. We'll be back again this time next week. If you've got any questions, then do fire away and drop us a message, and love to answer them next week for you. Until then, bye-bye.